Almost everyone thinks massive inflation is coming, including Buffett, Dalio, Burry, and even normal citizens like you and me. With so much attention around rising consumer prices, many investors have concluded that inflation is here to stay. Cathie Wood is seeing something completely different. New economic data is showing that inflation is rapidly decelerating and may only continue to do so. This video will go in depth on Cathie Wood's contrarian stance and how the US economy is rapidly weakening. From a broad perspective, it makes a lot of sense for inflation to start decelerating. Stimulus checks are no longer being given out. The Federal Reserve is starting to enter discussions to taper off as soon as this year, and the Delta variant is rapidly spreading across the US. Decelerating inflation, also known as disinflation, sounds logical because of the reasons I just mentioned. Recent economic data for the month of August also points towards disinflation. The most notable report that recently came out was significantly lower non-farm payrolls. The number of non-farm payrolls represents how many workers there are in the US, excluding farm workers. Non-farm payrolls are compared month over month or year over year so that economists can see the strength of the labor market. In the month of August, economists were expecting the labor market to be incredibly strong. The change in non-farm payrolls was expected to be higher by 733,000 in August compared to July. Contrary to expectations, non-farm payrolls only increased by 235,000. That difference is absolutely mind-blowing. Economists are usually off on their estimates, but not by that much. This is a strong signal that the economy is starting to weaken. There are several reasons why this could be happening. The two most obvious factors are that the chip shortage is worsening and the Delta variant is quickly spreading. Both of these factors may be hurting employment numbers in the short term. Additionally, there could be a more frightening factor at play, which we'll talk about soon.
Today, we got an employment report that was very weak relative to expectations. 235,000 increase in non-farm payrolls. The expectation, I think, was around 733,000. And last month, it was revised up to over 1 million. Now, we're trying to figure out, okay, what is happening here? Is it because of the Delta variant of the coronavirus and the pulling back of activity associated with that? Well, I guess this report corroborates that because leisure and hospitality employment was flat, and those numbers had been coming back very, very strongly until this month. So that's a probable reason. Is it because of supply chain issues? We're hearing about shortages, especially chip-related shortages, chips that go into everything manufacturing. Well, here too, we have some clues. Manufacturing hours worked were down 0.5%, which is a very big drop month to month. That's about 6% when you annualize it. So again, a big drop in a real indicator, not being influenced by inflation. Construction employment was also down. Again, there could be supply chain issues there.
We can clearly see that the Delta variant and the chip shortage are both serving a role in lowered employment numbers. There could also be one more factor at play, which is that the economy is starting to weaken. Cathie Wood has been warning about a deflationary crash for a while now, and it may be starting to kick in. Auto sales are quickly declining, as total vehicle sales have gone from 18.7 million in April to 13.4 million in August. This is partly caused by the chip shortage, but may also be because of the transition to electric vehicles. As I've covered in a previous video, the sales of electric vehicles have taken off during the pandemic. The rise of EVs could be playing a role in slowing auto sales, particularly sales from legacy auto. Another factor at play is the growing inventory in consumers' homes. Many people have already purchased vehicles during the pandemic to avoid mass transit. Chances are that they won't need to purchase another vehicle for a while. All of these three factors, which include the chip shortage, EVs, and consumer car inventory, are slowing the overall auto market.
I think what's beginning to happen is consumers having bought a lot of cars in the last year to avoid mass transit, a lot of them being used. They're now sitting back and saying, okay, I've already got my car. So the inventory is not on the dealer lots. Many people were quick to tell me on Twitter that couldn't I see the dealer lots are empty? Of course. Of course, there's a chip shortage, but maybe the inventory is in the consumer's driveway or garage. That's one thing that we think could be the case. Or maybe consumers are saying, for my next purchase, given the total cost of ownership has come down and is now below where gas-powered vehicles are, maybe I will buy an electric vehicle. And so there could be a pause in auto buying because of the technology shift that is underway.
Outside of the auto market, inflation is definitely starting to cool down. M2 Money, which is a tracker for the total money supply of the dollar, is currently decelerating by a substantial amount. M2 Money growth has slowed down from 27% year over year in February all the way down to 12% year over year in August. This may seem like a large drop-off, but it's only the beginning of much more to come. The money supply of the dollar is still growing at a rapid pace, but is also quickly decelerating. Based on the current sentiment, it's likely that the money supply will continue to decelerate even more. One potential catalyst for a further slowdown is the infrastructure bill coming in lower than expected. Consumers are very concerned with inflation and increasing US debt levels. This creates a situation that is the opposite of a self-fulfilling prophecy. Because US citizens are worried about inflation, politicians are now incentivized to control government spending. Attention towards inflation single-handedly lowers inflation, and that's just because of how politics works. One Democratic senator from West Virginia, Joe Manchin, believes that a massive infrastructure bill would be horrendous for the economy. Cathie Wood sees this as a signal that inflation will cool down in the short term.
I think we got a signal from Senator Manchin of West Virginia this week that he, and he has a very important vote in the Senate, he thinks $3.5 trillion is just ridiculous, given that government debt to GDP ratio in the United States has already passed 100%. Before the pandemic, we were in the 75-80% range. So 100% is quite the marker. And he's also concerned about inflation and that a fiscal package of that magnitude might aggravate some of the inflation indicators that have been flashing red recently. I think that's a very good thing. If he is not for this package, it's not going to pass. I think he's much more for the $500 to $1 trillion pure infrastructure package.
All of the indicators that we talked about just now are reflected in the bond market, which doesn't see inflation as a problem. What's even more worrying than inflation is actually deflation. An upcoming deflationary crash may lead to serious economic issues, especially as the economy quickly loses its pace. Innovation benefits from low to moderate inflation because of lowered interest rates. Lower interest rates lead to elevated levels of borrowing, which causes more spending on future growth. On the other side of the spectrum, high inflation would be devastating for innovation because higher interest rates lower the incentive to borrow money. Despite what we just talked about, Cathie believes that innovative stocks would still come out on top if inflation takes off, because in her words, innovation solves problems. This can be seen with the rise of cryptocurrencies as a hedge against inflation.
We really do believe that we're setting up for growth and particularly for innovation to take off again. Now, why are we saying this? Well, innovation solves problems, and we saw what happened in the coronavirus crisis. Innovation took off, and we've talked a lot about it, and we've moved into much more of a digital world much faster than otherwise would have been the case. Well, what are the problems now? Well, price increases are a problem, and consumers don't like them. So innovation does solve problems. I mentioned the electric vehicles. They're coming down in price, and they're better performing cars. They're better for the environment and so forth. So we believe the price decline associated with EVs is going to help solve the auto pricing problem. Cryptocurrencies have taken off as inflation fears have flamed. Crypto is a better hedge, Bitcoin in particular, is a better hedge against inflation if that's the fear than gold. Gold supplies will continue to increase over time as Bitcoin's supply starts to diminish in terms of the rate of increase.
The idea that inflation is about to accelerate has become a popular opinion lately. The most extreme example of this is Michael Burry, who sees inflation destroying the entire US economy. While Cathie Wood is going against the crowd, her argument does make a lot of sense. All of the indicators that caused high inflation in the first place are starting to cool down. Stimulus checks are no longer being given out, the auto market is slowing down, politicians don't want to spend as much money anymore, commodities are crashing, and most importantly, the labor market is slowing down. With that being said, if you're interested in furthering your investment knowledge, check out my research platform down below. My platform includes my main portfolio, my $25,000 portfolio, my watch list, research reports, strategic articles, valuation models, and much more. All of this is available in the first link down below. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.